Welcome to the deep dive. Today, we're digging into a whole pile of information. Get past the headlines and really understand what's happening with Philadelphia rentals right now. You know, Philly's always got something going on, but the rental market, it can feel like a bit of a maze. So our job today is pretty straightforward. Take this report, its sources, all this data, and unpack it together. We'll pull out the key facts, the important insights, so you can get up to speed quickly.
And it's a good time to do it. Philadelphia is, well, it's a fascinating market. So many different things influencing it. Big developments, neighborhood character, changing rules. Looking closely at the data, like what's in this report, is really essential. Doesn't matter if you're looking for a place, managing one, or thinking of investing.
Totally agree. So over the next bit, we'll hit the current numbers, look back a little, zoom into specific neighborhoods, see what's happening block by block. We'll also look at who's actually renting, what they want, the big picture forces like policy, the economy, weigh the pros and cons, opportunities, challenges, and then, try to see what the forecast looks like. Okay, let's dive in. Let's unpack this. So, starting with the current state of play, late 2024, early 2025. Average rent numbers, they seem to bounce around a bit. The summary we have shows maybe $650 up to $1,868. But then you see Redfin over $2,000. Rent Cafe right around $2,000 too. That's quite a difference.
It is. And that difference itself, that's kind of the first big takeaway, actually. It shows a single citywide average doesn't tell the whole story. Different sources track different things, you know. Some might include single-family homes, some only big apartment buildings. Methodologies differ. The real point here for you, listening, is if you're looking at a specific building, a specific block, you need that super local data. Like the report says, think about a landlord with a brand new high-end Class A building in Northern Liberties versus someone with an older row home in South Philly. Worlds apart, the city average. Almost meaningless for them.
Right. Context is everything. You got to drill down. Okay. What about occupancy? The report mentions pretty healthy rates, generally. A low to mid 90s percentile.
Yeah, things like 95.3%, 94.1%, depending on the quarter and source. So overall, places seem to be filled.
Seems good.
But, and this is a big but, that citywide number hides some really important variations. The data clearly shows much higher vacancy in certain submarkets.
Yeah.
Like significantly higher.
Where specifically?
Think Northern Liberty's 24% vacancy around May 2024. Fishtown, 20% around the same time.
Wow, 20 to 24% vacant. That's high. Why?
Simple reason, according to the data. A substantial influx of new apartment deliveries. Basically, a ton of new buildings finish construction and open their doors all at once in those spots.
Ah, okay. So suddenly renters have way more choices in those trendy neighborhoods.
Exactly.
Yeah.
Which puts pressure on landlords.
And that pressure shows up as concessions, right? The report calls them a critical leading indicator, especially downtown, even if the listed rent price hasn't officially dropped.
Precisely. Concessions has things like maybe 1 or 2 months free rent, maybe they pay your moving costs, stuff like that.
Right.
For you, this means the effective rent, what you actually end up paying over the whole lease, can be noticeably lower than the advertised price. And if you're a landlord in those specific high supply areas, you absolutely have to budget for offering concessions. It's just the market reality right now.
Okay, that makes sense. And speaking of all that new supply, 2024 saw a lot of units finish, like over 13,000.
A huge number, yes. But absorption, meaning how many got rented, was also pretty strong. Over 9,000 absorbed in one 12-month period mentioned.
But demand kept up, mostly.
It soaked up a good portion, yeah, even with that big wave hitting. But here's where it gets, well, really interesting for what's coming next. The forecast shows a major slowdown in new buildings finishing in 2025. The projection is way down, maybe only 5,300 units or so.
That's a big drop from over 13,000.
Huge drop. And the report flags this as a crucial factor. The thinking is, with much less new competition coming online, the market conditions will likely tighten up again. And that could mean, quote, potentially stronger rent growth in the medium term.
Okay, so 2024 was the year of the supply shock, causing some pain points, especially in certain areas. But 2025 looks like a much smaller wave, potentially shifting the balance back a bit.
That seems to be the expectation based on the construction pipeline, yes.
And just quickly looking back, the report mentions pretty solid rent growth leading up to this, right? From 2015 to 2021.
Yeah, substantial growth, including a really big jump regionally in 2021 alone, almost 10%.
10% in 1 year. That's great if you own property, but what does that do to affordability for the average person trying to rent?
Well, that's the other side of the coin. That kind of rapid run-up likely pushed a lot of renters towards their affordability ceiling, as the report puts it. So even if rent growth picks up again because supply slows down, that history plus what we know about current incomes and rent burdens, it suggests future increases might hit resistance faster, or push people to smaller units or further out.
Right. Affordability is a constant theme here. Okay, so citywide numbers only tell us so much. The report really hammers home. You need to look neighborhood by neighborhood in Philly. Let's do that. Center City's still the premier rental hub, highest rents. We're seeing numbers like $2,700 in Center City West, and averages around $750 for a one-bed, $2,800 for a two-bed.
That sounds about right. Lots of demand from professionals, but even there, that new supply wave meant concessions became part of the conversation.
Then you've got University City. Huge demand, premium prices. Some averages cited are over $3,300, though it varies. Driven by meds and eds, right?
Absolutely. Students, faculty, healthcare workers. It's got really high renter occupancy, fueled by the universities, the hospitals, and big projects like Schuylkill Yards.
What's the significance of meds and eds for the market?
Stability.
Yeah.
That's the key word. These institutions are less prone to big economic swings and layoffs compared to other sectors. So they provide this consistent, reliable flow of tenants, often needing housing for multiple years. It creates demand not just in U City itself, but spreads into nearby areas like Mantua, Powelton Village. Landlords there need to understand that cycle, maybe align leases with academic calendars. And, the report also notes the history of gentrification discussions in that area, which is an important context.
Definitely. Okay, then Fishtown and Northern Liberties. Super trendy, lots of growth, averages like $3,000 plus in no libs, over $2,100 in Fishtown for two beds. But, as we already talked about, this is ground zero for that 2024 supply impact. Those high vacancy rates, 24%, rents softening through concessions.
It's the perfect example of how quickly a flood of new supply can change the dynamic in a specific area, even a popular one. A real-time market adjustment.
The report also gives nods to South Philly Navy Yard development, changes in Point Breeze, Passink Square, and West Philadelphia, generally more affordable, but with a really crucial flag. You mentioned it earlier, an expected surge in rental inventory there in 2025. Why?
Yeah, it's tied directly to that 10-year tax abatement change we discussed. Basically, a lot of developers rushed to get permits before the rules changed to lock in the full abatement. Many of those projects, particularly in areas like West Philly, where lots of permits were pulled under the old rules, are now finishing construction around the same time in 2025.
So it's a policy-driven supply wave hitting specific areas next year. That's fascinating.
It really shows the direct link between policy decisions and near-term market conditions.
And briefly, Northeast Philly, generally the most affordable, stable, attracting families.
Right. And pulling back from these neighborhood stories, the big takeaway remains. Your experience as a renter or your strategy as a landlord is going to be intensely local. The city average is just a starting point.
Okay, so keeping that local variation in mind, how does Philly compare to other cities nearby? The report looks at this too. Philly versus Baltimore. Seems mixed. Some data suggests Philly is cheaper overall, but the report highlights Baltimore actually saw stronger recent rent growth, maybe just under 3%, and had less new inventory hitting the market compared to Philly since early 2023.
Yeah, different dynamics playing out recently.
Philly versus Boston. Okay, this is where it gets dark. Boston's two-bedroom median rent, over $4,200. Philly's, under $1,700 according to that source. Huge gap.
Massive difference.
And Philly versus D.C. Similar story, though not quite as extreme as Boston. DC's two-bedroom median around $3,500. Philly, again, under $1,700.
And this relative affordability is incredibly important. The report calls Philadelphia an affordability magnet. It's a fundamental driver of demand. People are literally moving to Philly from places like D.C., New York, Boston, because they can get more for their money here. That immigration is a core strength.
A key advantage. Okay, let's shift focus to the people actually living in these rentals. Who are they? The report mentions Philly's population dipped post-2020, but saw a slight uptick recently, maybe 10,000 more residents in the last year. Center City's still growing too?
Yeah, a modest recovery. But drilling down into demographics, two groups really stand out in driving rental demand. First, you've got this large cohort of young professionals aged 25-34. Many have degrees, and they're concentrated in places like Center City. Once 40% of residents there are between 22 and 34.
Okay, young pros. Who's the second group?
The fastest growing age group, actually.
Yeah.
Residents 65 and older. That group has increased by 20% in just the last decade.
Wow, 20% increase in seniors. And these two groups probably want different things, right?
Exactly. Young professionals often look for smaller, modern apartments, amenity-rich buildings, walkable locations close to work or nightlife. Seniors might prioritize accessibility features, low-maintenance living, single-floor layouts, and proximity to healthcare or cultural spots. Different needs, different demands on the housing stock.
And household size is shrinking slightly overall, around 2.3 persons.
Yes, that trend, even if population fluctuates, tends to push demand towards studios, one-bedrooms, and smaller two-bedroom units. Something for developers and landlords to keep in mind about unit mix.
What about incomes? The median is up around $60,700.
It's up about 19% since 2019 based on that data, which sounds good. But two caveats, it's still below national and metro averages. And the growth seems to have been stronger in the middle and upper income brackets, not necessarily keeping pace at the lower end.
Which brings us right back to affordability. The numbers are stark. Nearly half of renters cost burden, spending over 30% of income on rent. And for those earning under 50K, it's over three-quarters, 76%. That's huge.
It's a massive challenge. The report even estimates a shortage of about 17,000 units in areas where they're most needed. This points to what's sometimes called shadow demand. It's not just people eligible for subsidies, it's a large group looking for decent market rate housing that's simply less expensive than what's widely available, especially in desirable areas. It's a big underserved market.
And preferences are changing too, right? Remote work is a big one.
Huge. More people working from home, even part-time, increases the desire for a bit more space, maybe a dedicated home office nook, reliable high-speed internet becomes non-negotiable, maybe access to outdoor space feels more important.
Does this affect housing types like co-living?
It seems to be influencing the evolution of co-living, yes. The report suggests it's shifting. Less about maybe the purely social aspect, more towards practicality and affordability. So you see models catering specifically to students or even seniors like the second story concept mentioned. And then room-by-room rentals like pad split serve mobile workers or just people looking for the most affordable private space. It's adapting to meet these affordability and flexibility needs.
Okay, so beyond supply, demand, and preferences, what are the big external forces shaping the market? Let's talk regulations first. Mayor Parker's HOME plan sounds ambitious. $2 billion, 30,000 housing units targeted.
Very ambitious. For landlords and investors, it could mean opportunities for partnerships, potentially streamlining some processes. But it also means new competition, especially from the affordable units planned. 8,750 new rentals targeted. And critically, the report emphasizes staying vigilant about the evolving landlord-tenant laws. Things like the $50 cap on application fees, specific security deposit rules, the permanent eviction diversion program, expanding right to counsel for tenants. The regulatory environment is active and requires constant monitoring.
And we already hit the 10-year tax abatement change and its specific impact on 2025 supply in certain areas like West Philly.
Right, a direct policy lever creating a near-term market effect. Developers rush permits, leading to concentrated completions next year.
What about the broader Philly economy? Diverse, but meds and eds seems key.
It's absolutely key. Why? Stability again. Universities and hospitals are relatively recession-resistant. They provide this incredibly stable base of tenants, students, faculty, medical staff who need housing year after year. It acts as an anchor, providing a consistent baseline for rental demand that cushions Philly's market compared to cities maybe more reliant on volatile industries.
Makes sense. Infrastructure. SEPTA improvements are mentioned.
Yes, investments like streetcar modernization are positive. However, the report flags the SEPTA funding crisis as a considerable threat and a source of major uncertainty.
A threat? How so?
If the funding gap leads to significant service cuts, fewer trains, less frequent buses, it could really hurt accessibility for huge parts of the city. For neighborhoods that rely heavily on transit, that could negatively impact desirability, tenant demand, and ultimately property values. It's a big cloud hanging over things.
A major risk factor to watch. The report also touches briefly on environmental stuff, flood risk, sustainability, and tech, like smart homes, internet needs. Okay, this all feeds into the SWOT analysis in the report. Strengths, weaknesses, opportunities, threats for landlords and investors. Let's run through the highlights. Strengths. That diverse demand base. Meds and eds, young pros, affordability-driven migration. Relatively affordable compared to peer cities. Vibrant neighborhoods. Ongoing big projects like Schuylkill Yards, Navy Yard.
All solid points.
Weaknesses. Lots of older housing stock needing updates, potential issues like lead paint, high renter cost burden squeezing affordability, complex regulations, property taxes like use and occupancy tax, and those pockets of high vacancy we saw from recent supply like No Libs Fishtown.
Yeah, managing older stock and navigating rules are definite challenges.
Opportunities. Growth potential in emerging neighborhoods, brewery town, parts of West and South Philly are mentioned, catering to those specific tenant preferences, remote workspaces, smart tech, energy efficiency. Value add plays by improving older properties, leveraging new infrastructure, potential in affordable housing partnerships.
Lots of avenues for smart investment, yeah.
And threats. A general economic downturn hitting jobs and incomes. More regulations, potential rent control talk, just cause eviction rules, rising operating costs, insurance, taxes, utilities are going up, competition from that 2024 supply working through the system, that big SEPTA funding question mark, and interest rate swings making financing tricky.
That's a pretty comprehensive list of risks. And this SWOT, it's not just academic. For you, whether renting, owning, investing, this is the landscape. Understanding these points helps you make informed decisions.
Absolutely. So, given that complex picture, what kind of strategies does the report suggest for landlords? Even if you're a renter, understanding landlord strategy helps you see where the market might go. Key things seem to be hyperlocal data for setting rents, factoring in those concessions if you're in a high supply zone, prioritizing features people want now, home offices, outdoor space, good tech, energy savings. Also, proactive maintenance on older buildings, maybe exploring niche markets like specific co-living types or even short-term rentals were viable, and choosing locations near good infrastructure.
And on the risk side, it emphasizes being proactive. Stay completely current on regulations, manage environmental risks, get flood insurance if needed, screen tenants thoroughly, and keep a very close eye on SEPTA developments and interest rate trends. It's about managing uncertainty.
Okay, makes sense. Let's turn to the crystal ball. What does the forecast look like for 2025 and maybe the next few years? Near term, for 2025 itself, the expectation is for rent growth to actually accelerate moderately. CoStar's forecast, mentioned in the report, suggests around 3.0% year-over-year growth by the end of 2025. Interestingly, it notes some suburban submarkets, Cherry Hill, Mainline, Horsham, might see even stronger growth, potentially over 4%.
And the main reason behind that expected acceleration goes back to that projected slowdown in new multifamily supply. Less new stuff hitting the market gives existing properties a bit more pricing power.
Okay. What about occupancy in 2025?
Expected to stay pretty stable, maybe just above 93%, potentially firming up slightly to around 93.9% by year end, according to CoStar. And areas that didn't see a big construction boom are predicted to keep very high occupancy, like Lower Gloucester County potentially staying near 97%.
All right, so moderate acceleration in rents, stable occupancy for 2025. What about the medium term, say 2026 through 2029?
The outlook there is for continued moderate rent growth, maybe settling into a 2–4% annual range. Occupancy could also firm up a bit more.
Sounds steady.
But, and it's a significant but, this depends heavily on a few things. One, does that predicted slowdown in construction actually materialize and stick? Two, what happens with the broader economy? And three, how effective are local policies, like the HOME plan, in actually delivering new housing supply across different price points? The success of big projects will also lift specific neighborhoods.
So, lots of variables still.
Definitely. Continued job growth is key, especially in those stable sectors. Demographic trends need to hold. Big developments need to come fully online and integrate well. Philly needs to maintain that affordability advantage. And quality of life investments, including, yes, sorting out SEPTA matter.
The report outlines a baseline scenario, sort of the most likely path.
Yeah, it suggests a scenario with moderate economic growth, the housing plans achieving partial success, SEPTA finding some kind of resolution but maybe not ideal, and demographics staying steady. In that scenario, you land back at that 2–3% annual rent growth and stable occupancy in the low 90s percentile range. Steady, but not spectacular growth.
Okay, so wrapping this all up, the big picture seems to be Philly's rental market hit some turbulence, especially in 2024, mostly because a lot of new buildings opened in specific spots. That caused some temporary softening. But underlying demand seems strong, driven by jobs, demographics, and relative affordability. And with fewer new buildings expected in 2025, the market looks poised for moderate growth ahead. But affordability for renters remains a huge, persistent challenge weaving through all of this.
Absolutely. For you as a landlord or investor, success hinges on really good data, smart investments, efficient operations, and staying constantly aware of the rules and risks. For you as a renter, understanding these neighborhood nuances, the impact of new supply, and the overall affordability pressures is crucial for making your own decisions.
It's definitely a dynamic market. You've got clear strength, diverse demand, that affordability magnet effect, great neighborhoods, but also weaknesses, Aging buildings, tough regulations, the cost burden. Opportunities exist in growing areas and meeting new needs, but threats from the economy, policy shifts, and that big infrastructure question mark over SEPTA are very real. So maybe the final thought to leave you with, considering everything we've unpacked this surge and then projected slowdown in construction, the intense affordability crunch for so many people, and these ambitious city plans for housing. The big question is, how will all these competing forces truly reshape not just the rent check you write or collect, but the actual character, the feel of Philadelphia's diverse neighborhoods over the coming years? Something to think about. Thanks for joining us for this deep dive into the Philadelphia rental market. Keep exploring these topics, and we'll be here to help unpack the data.
The information provided on this podcast is for general informational purposes only. It is not intended to be financial or legal advice, and should not be construed or relied upon as such.